Hi, I'm Don Chambers, Chief Investment Officer of the Model Portfolios at Biltmore Capital. Today I'm describing Biltmore Capital's investment philosophy. In other words, describing how Biltmore Capital makes decisions as to how client assets are invested. Decisions from the top-level decision of asset allocation to the bottom-level decision of which particular securities or funds. Before delving into the details of our investment philosophy, I want to note that portfolio management is only one part of our many wealth management services. We also help clients design customized financial plans and guide our clients through life's countless financial decisions regarding risk management, issues such as insurance, and the many issues involved with estate planning. In short, we help our clients through the many challenges of making important financial decisions, not just for today, but for future generations, as wealth is passed to children and others. In a world of increasing complexity and ongoing uncertainty, it is essential to have a firm with a professional team that deals with these issues on a daily basis and is committed to providing unbiased advice. So let's get started on investment philosophy, which could be called our asset or portfolio management philosophy. Investing in general and managing portfolios in particular begins with the challenge of managing risk. The single most important investment principle is diversification. That is why diversification is the first thing I'm discussing. Our investment philosophy is to seek a high level of diversification because diversification can lower risk without lowering expected return. Improper diversification is the number one problem that I have encountered in my 30-plus years of talking to prospective clients who have had their money poorly managed. Biltmore Capital Advisor encourages very high levels of diversification, from the asset class level all the way down to the security level. Although I mentioned diversification first, another very important issue is selecting the right level of overall risk. In most asset classes, the overall risk of a portfolio can be reasonably summarized by the percentage of the portfolio that is placed in equity or risky funds rather than safer assets such as short-term bonds or other fixed income products. For example, if an investor is 80% in stocks and only 20% in bonds, they probably would be well described as having a somewhat aggressive portfolio, while the reverse combination, 80% in bonds and 20% in stocks, would be a somewhat conservative portfolio allocation. The overall asset allocation, roughly summarized as the percentage in various asset classes, such as stocks and bonds, is the biggest single determinant of financial performance and risk. For that reason, it is essential that the asset allocation decision is wisely made. But why take any risk at all? Our clients and each of our financial advisors in their personal lives are confronted with the reality that in order to receive attractive long-term performance, it is necessary to bear risks such as the risk of the stock market going down. If an investor takes zero financial risk, their investments will earn such low returns that the portfolio value will not even keep up with inflation on an after-tax basis. So in order to increase our chances of a financially healthy future, prudent investors take risks such as investing directly or indirectly in stocks, or buying bonds that are exposed to interest rate risk or credit risk, and so on. While taking some financial risk is an appropriate decision for most long-term investors with substantial assets, keep in mind that taking poorly diversified risk is not appropriate. That's why we diversify our own money and that of our clients. If we diversify across many stocks and bonds, we can spread out the risks of events such as corporate bankruptcies in a way that minimizes the portfolio's overall risk without reducing our portfolio's overall expected return. So at Biltmore Capital, our clients are not concentrated in the stocks and bonds of a handful of companies. Rather, our clients are diversified across thousands of firms through domestic and some international stock and bond markets. We also include some alternative investments, such as infrastructure, to further diversify our portfolio risk. So how can we find the proper amount of risk to bear, from conservative portfolios that have little or no equities to aggressive portfolios that are almost entirely invested in equities? Finding the right level of risk for a client starts with us getting to know our client, the risks they are willing to bear, and how that fits into their long-term financial planning activities. Our financial advisors work with each client to select an appropriate level of risk based on 3 factors. Number 1, your financial situation, including your total wealth level, potential pensions, liabilities, such as mortgages or margin loans, and major expenses, and so forth. Number 2, your goals or objectives. Include your plans and hopes for the future, and how much you wish to protect versus grow your wealth, and whether your focus is on your near-term financial situation or on bearing higher risk to achieve long-term potential growth. Number 3, your experience with investments and investing can be an important factor in understanding how to cope with the inevitable fluctuations in the stock market prices and interest rate levels. Our financial advisors get to know our clients using methods ranging from a short survey that targets the key issues related to risk preferences to informal, in-depth discussions to comprehensive financial plans. Based on knowing our clients and the feedback each client, with the help of their financial advisor, sets target levels of risk for their portfolios, ranging from very conservative with 100% fixed income to very aggressive with 100% equities or risky assets. Of course, most clients feel comfortable with more moderate exposures to equities and other risky assets, such as between 1/3 or 2/3 of their wealth in riskier assets such as stocks, rather than safe assets such as short-term high-quality bonds. Let's recap. The starting point is getting to know the client and finding an appropriate level of risk. This risk level is then pursued with a high level of diversification to determine the optimal asset allocation, which includes, for example, the mix of stocks and bonds, the mix of long-term versus short-term bonds, how much credit risk to bear, and so forth. There are 2 other important priorities in finding the right portfolio for our clients. These are, number 1, optimal minimization of income taxes, and 2, optimal minimization of fees. Income taxes can severely damage our future prosperity if not taken into account in the investment decisions. We analyze our clients' exposure to federal and, where applicable, state and even local income taxes. We make sure to take advantage of those investment decisions that can lower total income taxes without lowering a portfolio's pre-tax return. For example, we take into consideration whether a transaction will cause a long-term or short-term capital gain or loss, because the tax benefits and costs of transactions often depend on how long the investment was owned. We make sure that, when prudent, transactions are timed so as to lower the present value of investment income taxes paid by our clients. Also, we make sure that our clients only pay fees from their hard-earned money that are necessary to obtain high-quality management at the lowest cost. The investment opportunities that we seek for our clients provide excellent portfolio exposures with fees and other expenses that are fractions of the portfolio's value. For example, our clients' portfolio is often invested in exchange-traded mutual funds with fees of roughly only 10 basis points per year or less. We strive to find, and in some cases negotiate, the lowest possible transactions costs and margin rates, as well as proper investing and a solid investment philosophy are not based on hunches or guesses. They are based on experience, long-term evidence, wisdom, and attention to detail. Finally, I'd like to stress 2 core principles of Biltmore that extend throughout the many ways that we serve our clients: protecting your money and avoiding conflicts of interest. Let's begin with number 1, protecting your money. We utilize relationships with rock-solid financial institutions only, top-notch firms such as Schwab and TD Ameritrade, with strong balance sheets, insurance protection, and limited exposures to speculative lines of business such as proprietary trading. We were successful with these relationships before and all the way through the global financial crisis. We do this so that our clients' money is safeguarded from economy-wide financial crises and fraud by a particular firm. And we negotiate great deals for our clients in terms of fees and rates. You should be confident that your money is protected. All of your money stays in your name. We do not take possession of our clients' money. The money remains in your name until it is distributed by your authority. And the money is custodied by rock-solid financial institutions. We only possess a limited power of attorney that allows us to manage the money. Core principle number 2 at Biltmore is avoiding conflicts of interest. Our asset management process has 0 conflicts of interest. In my 30-plus years of investment management, I have seen the many clients of other firms suffer from the greed and conflicts of interest that are all too common in the world of investing. Our clients' portfolios are invested in publicly registered and listed securities. I refuse to participate in deals offered by salespeople who offer Biltmore commissions or to invest with outside money managers who provide Biltmore or me with extra compensation. This is a key reason that you can trust me. You can always trust me to always serve your best interests in selecting the securities and funds in your portfolio. While safety and careful risk management are high priorities, we also strive to enhance long-term returns. We have two primary methods of increasing portfolio returns. First, we modestly overweight or tilt portfolios towards investments that we believe offer superior return prospects. We base these decisions on two important factors: economic reasoning and long-term historical evidence. Second, we search for underpriced opportunities in markets that have historically offered superior opportunities through well-researched strategies. For example, we find that periodically substantially higher returns can be achieved through investment in closed-end funds rather than other types of funds. Our closed-end fund strategy takes more time to explain than is available here, but please check out our other videos and webinars to learn more, or better yet, give us a call so we can answer your questions directly. In summary, we at Biltmore would like to get to know you, your needs, and your goals. We want to place your hard-earned money into investments that are right for you. Please feel free to contact us to get started with a brighter financial future. Thank you.